All right, buckle up, everybody, because we are about to deep dive into investing and finance in early 2025. And wow, the sources you guys sent in it is a wild ride, isn't it? Doge slashing government jobs and tariffs and AI spending going bonkers and like a government shutdown looming. It's a lot to process, to say the least.
Definitely turbulent times. And that's where we come in. We are going to take a financial lens to all of this. Your sources are amazing. We've got Barbara Corcoran from Shark Tank, yeah, and we've got some top economic analysts, even some whispers, from Wall Street and venture capital. So by the time we're done here, you'll have a clearer picture of this crazy economy and hopefully a sense of how to actually navigate it, whether you're a seasoned investor or just dipping your toes in.
Okay, so let's get into it. First things first. What about these animal spirits the economic experts keep mentioning? That sounds a little, I don't know, zoo-ish. What does it really mean for someone who's like actually trying to figure out where to put their money in 2025?
Yeah, that's a great question. Animal spirits, it's basically the mood, the confidence of investors. When things feel shaky, like now everyone gets a little jittery, investors hesitate, maybe even get scared, and that could really mess with the market. Prices are all over the place, making it harder to predict what's next.
So it's like everyone's on edge, and that affects how the whole market performs. Makes sense.
Exactly. But here's the thing, that very volatility, it creates opportunities. If you can learn to read the signs, understand what's really driving those animal spirits, you might spot investments that other people are missing completely.
Makes sense, yeah. I'm seeing the connections here. Okay, I have to bring up Barbara Corcoran. I mean, come on, who doesn't love Barbara Corcoran? Her advice on pitching to VCs in your sources, it's gold, even if it feels a little old school in this crazy world. Dress sharp, over-prepared, answer their big question, how are they going to make money? Classic Corcoran. But does it still apply when VC funding is, supposedly drying up?
It definitely does. Look, Corcoran's advice may seem simple, but it's all about perspective, seeing things from the investor's point of view. Even when things are down, investors are still looking to make money, right? And that's Corcoran's point. You have to show them how your business, your idea, will deliver that return clearly and confidently.
Like you're speaking their language, showing them why their money's safe with you and how it'll grow even in this wild market.
Exactly. And Corcoran goes even further in one of your sources. She talks about this entrepreneur she mentored back in the 2008 recession. Guy was running a luxury travel business. Not exactly idealizing, right? But he adapted. He shifted to local experiences, staycations, and ended up thriving. Corcoran's point is that even in a down market, those who can think creatively, adapt, they'll find ways to succeed.
I love that example. It's like even if the economy throws you a curveball, you don't give up on your goals. You just got to adjust your swing, be more strategic, maybe channel a little bit of that Corcoran confidence while you're at it.
Couldn't agree more. So let's talk about how you can navigate this, because when it comes to investing, there isn't one right answer.
Right. And from what I'm seeing in the sources, the two main strategies you've highlighted are passive and active investing. Let's start with passive. Is it really as simple as it sounds, just riding the market wave and hoping for the best?
It's a bit more nuanced than that, but the core idea is to invest in broad market funds. Things like the S&P 500 or the total stock market. You let the overall growth do the work over time.
So I'm essentially betting on the whole market, not on individual companies. But hold on, what about all this talk of volatility and downturns? Won't get wipe out my gains?
That's where long-term thinking comes in. One of your economic experts, he highlights this incredible statistic. Despite 16 recessions, 25 bear markets, in the last century, the S&P 500, it's still averaged about 10% growth per year.
Wow, that's reassuring, honestly. So even with all the ups and downs, if I'm in it for the long haul, passive investing could actually be a solid option.
Exactly. It's what we call the always be buying strategy, or ABB. You consistently invest long-term, regardless of those short-term market hiccups. You're basically averaging your costs over time, buying more when prices are low and fewer when they're high.
Gotcha. So take the emotion of it and trust the historical trend. Okay, that makes sense. But what about for those of us who want to be a little more, hands-on with our investments? What about active investing?
That's where things get a little more exciting and potentially riskier, of course. Active investing is all about trying to actually beat the market. You pick individual stocks or sectors that you believe will outperform the average. And to do that, you need to understand those market shifts we were talking about.
And well, we've got some pretty major shifts happening right now. AI, government spending, Doge's reforms. It's a lot to keep track of.
Oh, absolutely. And to be a successful active investor, you've got to analyze those shifts. Dig into company financials, understand how different sectors are competing. It's about spotting trends before they become mainstream. Finding those companies that are poised to benefit and then making those calculated bets on their future.
So active investing is like, I don't know, being a detective or something. You're piecing together clues and trying to predict where the market's going next. Sounds like a lot of work, but potentially very rewarding.
It can be, yeah. But remember, active investing takes time, research, knowledge, and there's always a chance your predictions could be wrong.
Right, higher risk, higher potential reward. So anyone thinking about jumping into active investing, do your homework first and know your risk tolerance. Maybe even talk to a financial expert.
Couldn't agree more. And even then, nothing's guaranteed. But that's part of the fun in investing, right? It's a constant learning experience, balancing those risks with informed decisions.
Totally. So, speaking of calculated risks, how do you actually analyze these market shifts? Let's take, for example, Doge's government reforms. You mentioned them earlier, and obviously they're a big deal. But how do they translate into actual investment opportunities?
That's the million-dollar question, and that's where the detective work really starts. We need to break down Doge's reforms into their parts.
Okay, so there's his focus on government tech modernization, the cuts to those traditional government jobs, and that push for infrastructure spending. Where do we even begin with all of that?
Well, each of those pieces could create winners and losers in the market. For example, his focus on government tech modernization, that could be huge for cybersecurity companies, software developers, cloud computing. But it could also mean trouble for traditional government contractors, the ones who might lose out on those contracts.
So it's not as simple as just reading a headline and jumping in. You really have to understand the details, the nuances, and how it might affect specific companies.
Exactly. It means going beyond the headlines, digging into company filings, understanding their business models, and how they're positioned to take advantage of these shifts.
So like peeling back the layers of an onion, trying to find the core of the investment opportunity. But even then, there are no guarantees, are there? The market can be unpredictable, and even with all the best analysis, you could still be wrong.
That's the truth, which is why it's so important to diversify your investments, manage your risk, and be ready for both the good times and the bad times. But even with all that said, understanding these market shifts and how they impact different sectors, it's a crucial first step for anyone who wants to be an active investor.
Yeah, it's like you need both, right? Big picture thinking, analyzing those macro trends, and then that laser focus on individual companies, seeing which ones might benefit or get hurt by those trends. It's a lot to juggle.
It definitely is. But for those who put in the time and effort, active investing can be incredibly engaging and potentially very rewarding. And even if you're more into passive investing, just having a basic understanding of these market shifts can help you make better decisions about your portfolio.
It's like having an extra layer of knowledge. It lets you see the market from a different perspective. So, seasoned investor or just getting started, understanding these shifts is really key for anyone who wants to navigate finance in 2025. And with that in mind, I think we're ready to dive into the specifics of those two investment approaches, passive and active. What do you say we start with passive investing?
Sounds good to me. Let's explore what it means to ride that market wave. All right, so passive investing, it's often seen as the simpler approach. But there's still a lot to think about, especially now with the economy the way it is.
Right. You mentioned earlier the always be buying strategy, or ABB. Sounds catchy, but is it really that easy? Like, do I just throw money into the market every month no matter what's going on?
Well, not blindly, no. ABB is all about consistency and having that long-term perspective, but it also means understanding, your financial goals, how much risk you're comfortable with, and your time horizon. You're not ignoring those market changes, you're just riding them out.
So it's more like having a plan and sticking to it even when things get a little rough. Okay, I get that. But how do I even know which market funds to pick? There are so many options out there.
That's where, your personal situation comes in. If you want broad exposure to the market, funds like the S&P 500 or the total stock market are good places to start. They track a lot of companies, so you're getting a diverse piece of the whole market pie.
Okay, yeah, those are familiar names. But remember we talked about those historical returns, the S&P 500 averaging something like 10% growth every year, even with all those recessions. Does that still hold true in this crazy market?
That's the million-dollar question, isn't it? Past performance, it's never a guarantee of future results, and things right now, they definitely have their own unique challenges. But the idea behind those historical returns, it's still relevant. Over the long term, the market tends to go up. Remember those animal spirits. If people believe in the future, they'll keep investing, and that drives growth.
So it's like having faith in the market's ability to bounce back, even when things look a little gloomy in the short term.
Exactly, and that's where the discipline of ABB really comes in. By investing consistently over time, you're dollar cost averaging, buying more shares when the prices are low, fewer when they're high, It kind of smooths out the ride and potentially maximizes your returns in the long run.
It's like a built-in shock absorber for your portfolio, I guess. You're not freaking out and selling when the market dips. You're actually using those dips as a chance to buy more at a discount. Smart.
Exactly. But look, ABB isn't for everyone. It takes patience, discipline, and a long-term mindset. If you're someone who needs, more immediate results, or if you want to be more hands-on, then active investing might be a better fit for you.
Okay, let's talk about active investing then. You mentioned it's about trying to actually beat the market, which sounds kind of exciting, but also potentially risky. How do you even pick those winners, especially with everything going on right now?
That's where those market shifts we talked about become so important. Remember, we're not just following trends here. We're analyzing the underlying forces that are shaping the economy and looking for companies that are in a good position to benefit from those changes.
Can you give me an example, something that connects this to what's happening now in 2025?
Sure, let's look at Doge's push for government tech modernization. It's not just a political talking point, it's creating real investment opportunities. Think about cybersecurity companies, for example. As the government relies more on digital systems, the need for strong cybersecurity measures, it becomes even more important.
So an investor who's paying attention might look at those cybersecurity companies and see, okay, there's potential for growth there.
Exactly, and it goes beyond just cybersecurity. Doge's reforms, they also emphasize cloud computing and data analytics. So companies in those areas could also see significant growth as the government modernizes its infrastructure.
It's like following the money trail, but instead of, shady dealings, we're looking for legitimate investment opportunities that are being created by these policy changes.
I like that. That's a good way to put it. But remember, it's not just about following the headlines. You got to dig deeper, understand the nuances, and figure out which specific companies are in the best position to benefit.
So I'm looking at things like their financials, their management team, their track record of innovation, all of that.
Yep, exactly. You're looking for companies with a competitive edge, a solid business model, and a clear path to growth in this new landscape.
Okay, starting to get the picture. But even if I do all that research and find a company that looks promising, how do I know, I don't know, when to buy and when to sell? The market's so unpredictable.
Well, that's where understanding things like technical analysis, chart patterns, risk management strategies, that all comes in. It's a whole other layer of knowledge and skill that active investors need to develop.
So it's not just about finding the right companies, it's also about timing the market, knowing when to get in and when to get out to maximize your gains.
Precisely. And that requires a different mindset than passive investing. Active investing is about being more involved, making decisions more often, and being okay with a higher level of risk.
It sounds like active investing is really for a certain type of person, someone who enjoys the challenge, the research, and the potential for those bigger rewards, even if it comes with more risk.
I'd say that's accurate. And that's why it's so important to choose an investment strategy that really fits you, your goals, your risk tolerance, how much time you're willing to commit. There's no right or wrong answers, but about finding what works for you.
I like that. It's about knowing yourself, your strengths, your weaknesses, and choosing a path that you're comfortable with. But even with all this talk about strategy and analysis and all that, there's another really important piece we haven't fully explored yet, the mindset of a successful investor.
You're absolutely right. And honestly, it's often the most overlooked part of investing. Doesn't matter how much you know about technical analysis or market trends if you're not mentally prepared for the ups and downs.
So the psychological side of it, how do you stay calm when the market's going crazy? How do you stay rational?
That's where emotional intelligence comes in. One of your experts, the behavioral economist, he makes a great point about downturns actually being amazing buying opportunities, but only if you're emotionally and financially ready for them.
Okay, what does that mean, practically speaking? How do I become emotionally ready?
It starts with understanding that market volatility, it's normal. It's not a sign that you're failing. It's part of the cycle. And that means accepting that you will experience losses. It's going to happen at some point. It's inevitable.
So it's about managing expectations, knowing that there will be bad days, maybe even bad weeks or months, but not letting that short-term stuff derail your long-term goals.
Exactly. And that's where having a plan and sticking to it becomes so important. When the market dips and everyone else is losing their minds, you need the discipline to stay the course, even if it feels uncomfortable.
It's like having a compass that keeps you on track even when there's a hurricane going on around you. Got it. But what about the financial preparedness you mentioned? What does that look like?
That's about having a strong financial foundation. An emergency fund, paying down any high-interest debt you have and living within your means. Creating that buffer so that when the market inevitably takes the dip, you're not forced to make those rash decisions out of fear.
So it's like having a safety net so you can ride out the storm without having to sell your investments at a loss, just to cover your bills.
Precisely. Financial preparedness, it gives you the freedom to make rational choices, even when the market's, trying to get in your head.
I see. Yeah. It's like all these pieces, they fit together. Understanding the markets, having a strategy, and then this crucial element of being emotionally and financially prepared. Like if one piece is missing, the whole thing falls apart.
That's a great way to put it. It's so important to approach investing holistically. It's not just about the numbers. It's about knowing yourself, managing your emotions, and having that solid financial base.
And all of this applies whether you're a passive investor or an active investor, right?
Absolutely. The strategies might be different, but the underlying principles, they're the same.
So to recap, we've got passive investing, which is about riding the market wave, consistently putting money in over time, and trusting that the market will grow in the long run. Then there's active investing, which is more about trying to outsmart the market, analyzing those market shifts, finding promising companies, and making those calculated bets on their success. And then underlying both of those approaches is this crucial idea of mindset, being emotionally and financially prepared for those inevitable ups and downs.
That's a perfect summary. And as we head into the final part of our deep dive, I think it's important to go back to something Barbara Corcoran emphasized: the importance of understanding the investor's mindset, whether you're pitching a business idea or managing your own portfolio.
Okay, let's talk about that. What does it mean to think like an investor, especially in this environment? What are the key things to keep in mind?
Well, the first thing is investors are looking for value. They want to see a return on their investment, whether that's through dividends, stock appreciation, or the growth of a business.
So it's not about chasing the latest trends or getting caught up in the hype.
Not at all. It's about understanding the fundamentals, the financials, the business model, the competition. It's about looking beyond the surface and finding those companies or investments that have a strong foundation and a clear path to growth over the long term.
So we're back to being detectives, but this time we're looking for clues that indicate long-term value, not just like quick profits.
Exactly. Investors want to know that their money's being used wisely, that it's going towards something that has real potential to create lasting value.
And I imagine that becomes even more important in a market like this one with all the volatility in 2025.
Oh, absolutely. When the economy's uncertain, investors get more cautious, right? They're looking for stability, companies that can handle the tough times and come out stronger on the other side.
So it's not just growth they're looking for, it's resilience. Companies that have a proven track record of adapting and navigating through tough times.
Precisely. And that's why understanding those market shifts, those big forces we talked about earlier, it's so important. Investors want to see that you're not just chasing the latest fad, you're looking ahead. You're anticipating the long-term trends that are shaping the economy and figuring out how to use those trends to your advantage.
Like being a chess player, you're always thinking a few moves ahead, trying to figure out your opponent's strategy.
That's a great analogy. Successful investors, they're always thinking about the big picture, the long game. They don't get distracted by those short-term changes. They're focused on building a portfolio that's going to generate consistent returns over time.
And that takes what? Discipline, patience, emotional intelligence, all of the above.
All of the above, yeah. It's about staying focused on your goals, managing your risk, and not letting, fear or greed control your decisions.
So it's not just about understanding the numbers, it's also about understanding human psychology, both your own and psychology of the market itself.
Exactly. Investing, it's as much about psychology as it is about finance.
Which leads us perfectly into our final point for this deep dive, the mindset of a winning investor. We've talked about it throughout our conversation, but let's really get into the specifics here.
Let's do it. Let's explore the mental and emotional tools that the most successful investors use to navigate this complex, ever-changing world. All right, let's dig into this. We've talked about the strategies, the market shifts, doing your due diligence, all of that. But at the end of the day, yeah, investing is a mental game. You got to make decisions under pressure, manage risk, and not let your emotions, cloud your judgment.
It really is. So what are those key traits that set the really successful investors apart? Is it just about being good with numbers, or is there more to it than that?
Well, being analytical is important, but it's not the whole picture. One of your sources, the behavioral economist, he makes a great point about emotional intelligence being maybe even more important.
Emotional intelligence. So like being self-aware, knowing how your emotions might be affecting your decisions, that kind of thing.
Exactly. Think about those animal spirits again. When fear takes over, people tend to make bad decisions. They sell low, buy high, the opposite of what they should be doing.
So a winning investor is someone who can like spot those emotional triggers, the fear, the greed, and not let those feelings control their actions.
Exactly. They can take a step back, look at the situation objectively, and make decisions based on logic and their long-term plan, not just on how they're feeling at that moment.
Like having, I don't know, like an internal thermostat or something. It keeps you steady no matter what the market's doing.
I like that analogy. It's about keeping things in perspective. Knowing that those market swings, they're normal, and not letting those short-term changes throw you off your long-term goals.
Okay, so emotional intelligence, that's a big one. What else goes into this winning investor mindset?
Discipline. Having a plan is one thing, but sticking to it, especially when the market's testing you, that's something else entirely.
Yeah, especially when you see other people, making these quick profits or maybe panicking and selling everything off. It's easy to get swept up in that.
Oh, for sure. But the winning investors, they understand that discipline is what sets them apart. They can tune out all that noise, focus on their own goals, and stay on track, even when it's tempting to do something else.
So it's about having that inner strength, I guess, to resist those urges, like not chasing the latest hot stock tip or not selling everything when the market dips.
Exactly. Discipline is what lets you make those rational decisions. Decisions based on your plan, not on what the market's doing today or what other people are doing.
And that discipline, it connects back to the patience we talked about before, right? Passive investing, it seems it's all about the long game, being committed to riding out those ups and downs.
Absolutely. A winning investor knows that building wealth, it takes time. There's no quick fix, no secret formula. It's about consistency, saving, and investing patiently.
So they're not looking for instant results. They're playing the long game, understanding that real wealth, it's built over years, decades even, not days or weeks.
Right. They're able to delay that gratification, resist the urge to chase those quick wins, and instead they focus on building that solid financial foundation that'll support them for the long haul.
Okay, so you've got emotional intelligence, discipline, patience. What else? What else rounds out this winning mindset?
Adaptability. The market's constantly changing. New trends pop up, unexpected things happen. A winning investor, they have to be able to adjust their strategy, take in new information, and make decisions based on what's happening now, not on some outdated idea of how things work.
So they're not stuck in their ways. They're willing to learn and evolve, change their approach if they need to. Basically, they're lifelong learners when it comes to investing.
Exactly. They're always looking for new knowledge, reading the news, going to conferences, talking to other investors. They know that the only thing that's constant in the market is change, and they embrace that change. They're not afraid of it.
And I imagine that adaptability is even more crucial now in 2025 with all the crazy stuff happening. Doge's reforms, AI, those trade tensions, it's a lot.
Oh, absolutely. It's a volatile and unpredictable landscape, that's for sure. A winning investor has to be able to navigate that uncertainty, make sense of the chaos, and adapt their strategy to fit what's going on.
So it's kind of like being a ship captain or sorry. You've got to read the charts, adjust your course, stay calm when the storm hits.
I love that. That's a great analogy. A winning investor, they're not afraid in the storm. They're ready for it. They have the skills, the knowledge, and the mental toughness to weather any storm and come out even stronger.
And that brings us right back to Barbara Corcoran's advice about understanding the investor's mindset. It's not just about the numbers, it's about understanding people, understanding yourself and how people in the market, they tend to behave.
Exactly. Investment is just as much about psychology as it is about finance.
Okay, so we've covered a lot of ground here. The economic landscape in early 2025, the challenges and opportunities, different approaches to investing, and of course, the importance of having the right mindset. What are the key takeaways you want our listeners to remember?
First and foremost, knowledge is power. The more you know about the market, the better your decisions will be, and the more confident you'll feel. Passive investing, active investing, whatever you choose, do your research, understand the risks, and come up with a plan that fits your goals and your risk tolerance.
And don't forget the emotional side of it. Build that winning mindset. Emotional intelligence, discipline, patience, adaptability, all of that. Investing is a marathon, not a sprint.
Couldn't have said it better myself. And finally, never stop learning. The market's always changing. New trends, new opportunities, they're always popping up. Stay curious, stay informed, and don't be afraid to change your strategy when you need to.
So much good stuff here. Well, I think that brings us to the end of our deep dive into the world of investing and finance in early 2025. We hope you found this exploration insightful, informative, and maybe even a little bit inspiring.
The future is yours to create. By taking control of your finances, making smart decisions, and developing that winning investor mindset, you can achieve your financial goals and build the future that you want.
That's it for us today. Thanks for joining us on this wild ride through the world of finance. Until next time, keep exploring, keep learning, and keep investing in yourselves.